Thanks for joining me today. We're going to tune in to the Bank of Canada's Monetary Policy Report release. And it seems like Tiff Macklem, the governor of the Bank of Canada, is going to be the one here at this press conference that reporters are going to be able to ask questions to. If you're just tuning in, let me know if you can hear me okay, if everything's all working tech-wise. Sometimes these streams can be a little bit touch and go, but either way, I'm happy to have you here. Make sure to drop a like on the stream to get this out to more people. As you can see here, we're just waiting on them to actually start this the Bank of Canada press conference. Let me just make sure that this is all looking good and is all set up so that we can take a look at what's going on. All right, perfect. Beautiful. How's it going, everyone? We did get the information on the monetary policy report and what was inside of it actually just recently. Let me actually pull up that monetary report and we can go over it a little bit before they start their press conference, which is supposed to start here in the next few minutes, so stay tuned for that. Bank of Canada Monetary Policy Report. Okay, awesome. I'm seeing people in the chat. We've got Twister and Mark and Marilyn here also. That's awesome. How's it going, you guys? It sounds good in Calgary. I'm glad I'm coming through loud and clear for you. All right, so the monetary policy report we just had released this morning. Let's pull it up and see if there's any key information in here before we actually get to this press conference that's set to start off here. Okay, so the Bank of Canada maintains policy rate and forward guidance adjusts quantitative easing program. This is one of the things that we actually expected to happen, was them to taper their monetary or their quantitative easing program, or the QE program. That's essentially the bond buying program where they're buying millions, or actually buying billions of dollars of Bank of Canada bonds directly from the bond market, sort of pushing down interest rates. Now, typically, it's been it was at 5 million at the beginning of the pandemic, and it slowly started to be tapered now down to 4 billion per week, 3 billion per week, and now it seems, and this is what we were sort of expecting if you watched the video yesterday, we were sort of expecting, here, let me pull up my sort of annotation software so you can see what I'm looking at. Yeah, it seems like they're going to be lowering this down to $2 billion per week. So that is the decrease that we expected to see, and that could have an impact on interest rates, right? Okay, but they're going to keep the effective overnight rate at the effective lower bound of 0.25%, with the bank rate at 0.5%. So this is the overnight rate, and essentially governs like what different banks pay in interest to each other when they sort of loan money to each other on a short-term basis. This happens all the time. So that does have an effect, but it's going to be interesting to see how the bond market sort of reacts to this sort of tapering of the Bank of Canada's ability to purchase those bonds. Now, I'm just going to throw this page on my other screen here so I make sure we don't miss it. So they're saying the global economy is recovering strongly from the COVID-19 pandemic, with continued progress on vaccinations, particularly in advanced economies. However, the recovery is still highly uneven and remains dependent on the course of the virus. The recent spread of new COVID-19 variants is a growing concern, especially for regions where vaccination rates remain low. Okay, interesting. So a little bit of commentary on the global economy here. So it seems like they are sort of being rather positive here about how things are likely going to go, with more people getting vaccinated, the economy opening up, more jobs being available. But this is one thing that I got a lot of comments on my video yesterday. It was a lot of people were worried that, hey, the job numbers that we're seeing right now don't actually reflect like solid jobs, right? They don't reflect full-time positions, mostly just like part-time, people going back to the various service industries. So it's interesting how we count the numbers, whether it's counting every single type of job, or if it's counting just the ones that are actually jobs that people want to stay in long term. And I think they make mention of this in the monetary policy. I was skimming this a little bit just before we started the stream. They say that, but we'll get to that in a second, I'm sure. And I'm sure Tiff Macklem, just in a few minutes, again, we're waiting on him to start if you're just doing the stream. It's supposed to start in about probably about 1 minute now. Yeah, or right now is when it's supposed to start. But we're probably going to get more information on how exactly they're monitoring that rather soon. But let's keep on going here. Oh my goodness, that's a big. Global GDP growth is expected to reach 7% this year and then moderate to about 4.5% in 2022 and just over 3% in 2023. Oh, we've got the press conference starting here. I'm going to pull this up for you so that you can see what's going on and so I can make sure you can hear everything. I'll throw my headphones on. Let's get in.
Attention. A year ago, it was my first NPR as governor, and the economy was in a very deep hole. We were just coming out of the first wave of the virus. More than 2 million Canadians were unemployed, and inflation was well below our 1% to 3% inflation target range. Uncertainty was extremely high. Vaccines were being developed, but nobody knew when they'd be available or even if they'd be effective. Beaucoup de choses sont passées depuis. Il y a eu deux autres vagues de virus, ce qui a retardé la reprise. Mais grâce à la résilience des ménages et des entreprises du pays et les mesures budgétaires et monétaires exceptionnelles, l'économie a continué à croître. La croissance a été volatile et très inégale. Tout le monde a été confronté à beaucoup.
Again, if you tuned into any of these streams, you'll know that my French is not all that great. So hopefully he's going to go into English here. It sounds like he might right now. Oh, or not. It sounds like he's rather positive.
C'est pourquoi le conseil de direction s'attend à un fort rebond à la réouverture de l'économie. Nous croyons que cette fois, la croissance sera plus durable. My second message is that the unique characteristics of the pandemic have continue to evolve, and there is continued need for careful attention to the dynamics of the recovery and to inflation. Globally, the economic outlook remains highly dependent on the virus, and these new variants are a growing source of concern. In Canada, we still have some way to go to a complete recovery, and the rebound in economic activity will proceed at different speeds across different sectors. The process of reopening the economy, it's not going to be entirely smooth. For example, we're experiencing supply bottlenecks for some goods and services as demand rebounds faster than supply can ramp back up. These unique circumstances of the pandemic are now helping to push inflation temporarily above our target range. As we reopen the economy, we can expect to see some volatility, and my message to you is that we will continue to pay close attention to the progress in the recovery and to the evolution of inflation. Before I turn to your questions, let me say a few words about the Governing Council's policy discussions. We spent some time considering the progress of and the risks to the global economic recovery. The global economy is recovering strongly, but vaccination rates and growth are uneven across advanced and emerging market economies. Growth is particularly strong in the United States, which is further ahead in the reopening and is benefiting from considerable fiscal stimulus. Oil prices have moved higher with stronger global demand, while other commodity prices have remained elevated. The Canadian dollar is close to where it was in April relative to the US dollar and slightly stronger against a broader basket of currencies. Coming back to Canada, we discussed the many ways in which the pandemic is affecting our economy and the prospects for recovery. There was a strong consensus that growth will strengthen and broaden in the months ahead as consumers return to more normal spending patterns, higher foreign demand lifts our exports, and investment increases. Consumption is expected to lead the recovery. Some of the sectors hit by the lockdowns, including retail, restaurant, and other hard-to-distance sectors, are already seeing a rebound, and others, like business and international travel, they may take a little bit longer to recover. Employment should continue to rebound over the next few months as the reopening process continues. The job gains we saw in June are certainly encouraging, particularly for workers in the service sectors that have really borne the brunt of the job losses. But to get back to the pre-pandemic employment rate, we still have more than 500,000 jobs to recoup. Our Business Outlook survey showed that plans to hire staff are widespread as firms prepare for rising demand. But finding workers with the right skills can be difficult, and that process could take some time. Si on compare les perspectives actuelles à notre prévision d'avril, on voit que la croissance au premier semestre
So
est un peu plus faible.
we're gonna just turn this down a little bit, and we'll wait for the English to come back. So some interesting insights there from Tiff Macklem. He kind of made the point that like he said it in a very stern tone, saying like, we are going to keep an eye on inflation. That was sort of like a more cautious tone than he's typically taken previously, saying that inflation's just here today, gone tomorrow, it's transitory. This has been one of his talking points. But it seems like he's a little bit more concerned about it, saying, hey, I'm assuring you guys, we're going to keep our eyes on inflation and monitor our policy based on that. Sorry, I'm just pausing here to listen in to make sure he's not back to English and we're not missing anything. So he went on in saying that the economic reopening won't be smooth, and again, he emphasized they need to keep an eye on inflation, but he does think that there will be more growth, higher foreign demand for Canadian exports, and that employment should continue to rebound, saying that the June jobs numbers, I think we went down to like 7.2% from 8 point something percent. That job gain is good to see. Particularly, again, he said, for workers in the service sector. I actually don't, I'm seeing people in the chat saying, can you turn on translated CC? I don't think that there actually is even the option for that. I'm trying to see. Yeah, because it's live. I don't think there's live closed captions. But here we go.
Supply in the economy, as well as a number of temporary factors. In recent months, the consumer price inflation, the CPI, has risen above the bank's 1 to 3% target range. And there are three major factors behind the temporary strength, and they're all related to the pandemic. First, gasoline prices rebounded from very low levels a year ago and are now above pre-pandemic levels. Second, some other prices that had fallen sharply when demand was plummeting a year ago are now recovering to more normal levels as we reopen the economy. And third, disrupted global supply chains and pandemic-related supply constraints, including shipping bottlenecks and global shortages in semiconductors, have pushed up the prices for cars and some other goods. What we're seeing is that supply bottlenecks are creating sharp movements in prices that's pushing inflation temporarily higher, and these supply issues now look to be more important than we previously thought. As a result, inflation is now projected to be somewhat above the target band through 2021. But these temporary effects are forecast to dissipate near the end of this year, and inflation is forecast to ease back towards 2% in 2022. We expect the factors pushing up inflation to be temporary, but their persistence and magnitude are uncertain, and we will be watching them very closely. Longer term, given our commitment to hold the policy rate at the effective lower bound until slack is absorbed, the economy is projected to move into modest excess demand, so inflation is slightly above target through 2023 before moving toward target in 2024. In sum, reopening the economy and the strong progress on vaccinations has given us reason to be more optimistic about the direction of the economy. But we're not there yet, and we are mindful the process is likely to be bumpy and some scars will remain. At today's decision, the Governing Council judged that the recovery still needs extraordinary support from monetary policy. We remain committed to holding the policy rate at the effective lower bound until slack is absorbed, so that the 2% inflation target is sustainably achieved. Based on our current projection, that happens sometime in the second half of 2022. Our quantitative easing program continues to reinforce this commitment. We decided to adjust the program to a target of $2 billion of weekly purchases of Government of Canada bonds, which is down from a target of $3 billion a week. This adjustment reflects continued progress towards recovery and the bank's increased confidence in the strength of the Canadian economic outlook. Les décisions au sujet de tout autre ajustement du rythme des achats net obligations seront guidées par l'évaluation et contenu que fait le Conseil de direction de la robustesse et de la durabilité de la reprise. Si l'économie évolue en gros selon nos projections, on pourrait réduire les dettes.
Okay, so some more interesting stuff in there. Definitely some interesting takes from Tiff Macklem here. He talked a lot about the CPI. If you're watching this, you're probably already familiar with the CPI and how we use that as what we use that as the measure for inflation. Now, some people will disagree that CPI. Oh, never mind. It's English. We'll talk more about this soon.
Purchases will be guided by the Governing Council's ongoing assessment of the strength and durability of the recovery. If the economy evolves broadly in line with the outlook, then over time, we won't need as much QE. Further adjustments to our QE program will continue to be gradual, and we will be deliberate both in our assessment of incoming data and in the communication of our analysis. We will continue to provide the appropriate degree of monetary policy stimulus to support recovery and achieve the inflation target. And with that, I'd be very pleased to take your questions.
Thank you, Governor. And we will go to questions now.
Okay, interesting. Yeah, so that was just a pretty brief speech about this monetary policy report. This is where the interesting stuff is, though, because if you're just tuning in for that press conference, his speech portion, well, that's just the start of it, because he gets to say whatever he wants to say. Now, this is typically where we get the actually solid insights, because the Bank of Canada's pressed on some of the questions that people have, some of the critiques that they have of them, largely because these reporters are hopefully going to ask some pretty juicy questions here. So let's take a look at this. It's going to be interesting to listen into.
We're going to try to do one question per reporter in this first round with a quick follow-up, and I'll ask you to state your name and affiliation. I just want to remind people to mute their line if they're not asking a question. You can do so by pressing *6 and unmute by pressing *6 again. Avant de poser une question, veuillez vous identifier et libre à vous de poser vos questions dans la langue officielle de votre choix. Pour mettre votre ligne en mode discrétion, appuyez sur étoile 6. Pour l'enlever, faites étoile 6 encore une fois. So we'll get started with Julie Gordon from Reuters, followed by Greg Bonnell from BNN Bloomberg, and Mark Rendell of the Globe and Mail. So Julie, I'll turn to you for the first question.
Hi there, Governor. Thank you so much for taking our questions again today. You had to adjust your inflation outlook because it has been more sustained than expected. What is it makes you forecast that it is still going to be transitory?
Well, good morning, Julie. Look, there are three sets of factors or reasons why we believe that this rise in inflation will be temporary. First of all, when you look at what's actually driving inflation higher, these look like temporary factors. Secondly, there's still a considerable amount of slack in the economy, and that will put downward pressure on inflation. It is putting downward pressure on inflation, and that's going to continue until the output gap is closed. And third, when we look at survey evidence, when we ask firms about their intentions, what we see is the evidence suggests that this isn't going to continue. So let me just unpack those for you in a little more detail. So as I said, the first factor is when we look at what's actually driving inflation higher, these things look temporary. There is a combination of factors. So keep in mind that the first point is that inflation a year ago was very low. It was about 0. And so as prices today are being compared to very low prices a year ago. So you take gasoline, for example, before the pandemic, it was about $1.30 a liter. Last year, it was down to 70 cents a liter, 70-something cents a liter. I filled up last week, it was $1.36. So, that $1.36 is getting compared to the very low prices a year ago, so that's a big boost to inflation. There are some other goods and services whose prices plummeted in the darkest days of the pandemic, a little over a year ago. And as those prices normalize, again, you're getting some large year-over-year increases. But really, these prices are basically normalizing to where they were before the pandemic. We call this base year effects. The third factor is, and this is what is really getting more emphasis in this report. This is what is newer, is there are a number of supply bottlenecks. A couple of examples. Global shipping prices have gone up, and that really reflects the fact that because we can't buy a lot of services we want to buy, we're substituting into goods. You can't go to your local gym, so maybe you bought an exercise bike or a treadmill. Those goods all have to get shipped. There's a lot of demand for shipping of goods. Prices of shipping have gone up as shipping adds capacity, and that's temporarily boosting. That's boosting the prices, which is temporarily boosting inflation. Semiconductors, there are disruptions in the global supply chain for semiconductors. That's showing up in car prices, for example. Remind you that inflation is ongoing increases in prices. What we're seeing are some sharp movements in prices, but that doesn't look like inflation. It's unlikely to cause ongoing price increases. So these effects on inflation should be temporary. So that's the first set of factors. The second is there's a lot of excess supply in this economy. There are still many Canadians out of work. You look at some numbers, we estimate the output gap is between -2 or 3%. Unemployment's 7.8%. That's about 2 percentage points above the pre-pandemic level. Total hours worked still 4%, more than 4% below pre-pandemic levels. We're still, as I mentioned in my opening statement, to get back to the same employment rate, we still need to recoup more than 500,000 jobs. So no matter how you look at it, there's still a considerable amount of slack in the economy. That's putting downward pressure on inflation. So as those temporary factors wane, inflation will come down. And then finally is a range of survey evidence. If you look at surveys of inflation expectations, if you look at implied inflation expectations in the term structure, longer run inflation expectations have really not moved at all. People are not expecting this to be durably higher inflation. And when we asked firms, in our Business Outlook survey, we went and we asked firms, what are your plans? And 60% indicated that they expected the pace of price increases this year to be similar or lower than pre-pandemic. 15% said they would be higher, and that does reflect that we are definitely seeing some price pressures in some specific areas, but it's not broad-based. So look, let me just sort of summarize a long answer, but it's an important question. Of course, there's some uncertainty here. We don't have a crystal ball. We expect these effects to dissipate later in the year. And if you look at our forecast, inflation comes down to 2%, sort of second half of next year. But sure, there's some uncertainty about this. We will be watching these effects. We will be watching the evolution of inflation very carefully.
Wow, that's interesting. So a lot of emphasis from Tiff Macklem there on what's going on with inflation, saying that there's three major factors that are affecting it. The sort of temporary factors, remember the base year effects, how we're comparing it to last year's numbers. Also gas prices, supply bottlenecks, global shipping prices, more demand for shipping causing those prices to go up. The semiconductor shortage, the chip shortage in cars, all of these, Tiff Macklem in the Bank of Canada says this is just short-term stuff. And he says that inflation is only consistent price increase, so they're not really counting these sharp increases that they expect will even out over time. Definitely an interesting take. And also he mentions there that when they asked firms, they said that they don't think it will stick around. So essentially they're doing surveys on inflation expectations and using those expectations as part of how they're forecasting inflation. This is a little bit interesting. There is an argument to be made that inflation and inflation forecasts can kind of be self-fulfilling, because if you think that there's going to be inflation, you're more likely to spend money because that money that you have will be less valuable in the future. But the fact that you're spending more money now causes more inflation, right? So a little bit of self-fulfilling there. Let's see what else he has to say and what this next question's all about.
Okay, thank you for that. And as a follow-up, has the housing market frenzy passed its peak, or do you foresee some price escalation again later this year?
Well, if you look at our outlook in the monetary policy report for housing. We've already seen some moderation in housing activity. The levels remain quite elevated, but we've seen some moderation. We do expect to see continued gradual moderation. In the last part of the report, in the risks, we indicate, look, there are some risks around that. That moderation could be faster than we expected, than we've projected. There's no question that an important reason, one of the unusual circumstances of the pandemic is that everybody's been at home and people are working at home, their recreation is at home, their children are studying at home, their meals are all at home. Understandably, they wanted more space, and that's boosted demand for housing. We'll have to see. Once we can all go, now that we can go back to a restaurant, do you still want a bigger kitchen? We'll see. So that's hard to gauge. It could come back faster. On the other hand, we've got a relatively strong growth forecast. We expect Canadians will be getting back to work. They will be feeling more confident about their incomes. We expect immigration rates to ramp back up. That's important to growing the potential of our economy. So, there are also some other reasons why it could be stronger. I think what we've put in our report, I think, provides a balanced view.
Okay, we'll go now to Greg Bunnell from BNN Bloomberg, followed by Mark Rendell of The Globe. Greg.
Hi, yes, Governor. Thanks for taking my question. I want to talk about the recovery in the sense that it's highly logical to think that the consumer will lead this recovery, and then at some point you're hoping it strengthens beyond that. I see exports mentioned. When I was going through the documents, I had to stop back several years to your predecessor, Stephen Poloz, waiting for the consumer who had carried the economy on their back coming out of the financial crisis to sort of give way to the exports, and it sort of didn't come. I mean, what's the risk here as we try to hand off growth from one area to another, that we get stuck just relying on the consumer for a very long time, just like we did at the financial crisis, and we know the carrot there is cheap money. How long do we get stuck in this idea that we need to keep providing cheap money to the consumer to carry this economy?
Well, Greg, as I've indicated, we do expect this to be a consumer-led recovery. And one of the things that has struck us through this pandemic is just how resilient the consumer has been. That has a lot to do with exceptional fiscal support and monetary policy stimulus. And as Canadians, we've already, we had something like more than 3 million Canadians at the worst. We're now back to it's about 350,000 jobs to go to get back to pre-pandemic level, or about half a million to get back to the same employment rate. So we still have some way to go, but we've come a long way back. And with those incomes, we expect to see consumer spending. Frankly, we expect to see Canadians getting back to more normal spending patterns as the economy reopens, and increasingly they're getting back to work. On the export side, the U.S., our U.S. economy is strong. Our U.S. outlook is strong. U.S. is by far our biggest destination for exports. It's clear that the U.S. economy is experiencing some capacity constraints. So we do expect that the demand for our exports will be lifted by that strong U.S. economy. And when you've got good consumption growth and good export growth, that's when firms start to invest more. Firms become more confident that the demand will be there, and they really start investing and adding capacity. When we look at our own business outlook survey, we do see business investment intentions have strengthened. And going forward, we expect to see business confidence firm further, and we do expect to see this broadening from consumption to exports to investment. Are there some risks around that? Sure, there's some risks around that. Coming back to exports, if the Canadian dollar, in our projection, we assume the Canadian dollar remains about where it is, around 80 cents. If the Canadian dollar were to move higher, that would put additional competitive pressure on our exporters. It would make imports more attractive. That could certainly take something off our projection, and that's something we'd have to take into account.
As a quick follow-up, I just want to ask you, you mentioned obviously how key the labor market recovery is to this. We talked to a lot of business leaders on BNN Bloomberg, of course, and they're telling us it's pretty hard to find workers, that it's competitive. That suggests, of course, that you have to pay people more money to win them over to come join your organization, and that feeds into inflation. So how could all that sort of spiral into a way that you get an inflation that is not transitory? Because workers usually don't like to give back their raises.
Well, look, as I mentioned, I think one of the things we are learning more about is it's a lot easier to close the economy than it is to reopen.
That's a good question.
And particularly in some sectors, demand can rebound faster than supply can keep up. I mean, you think about a restaurant. Normally if your restaurant's operating and you want to expand, so maybe you need to hire a few more workers. Most restaurants now have been virtually closed or operating with really skeletal staff. They've got a lot of people to hire. That's going to take some time. And that's part of this complicated process of reopening the economy. And yes, we are hearing through our own Business Outlook survey that some companies are having trouble finding the workers they need. They're having trouble finding the skills they need. They need to invest in training. That's going to take some time. But these are sort of temporary adjustment issues as you reopen the economy. And one of the things we have seen repeatedly through this crisis is there's a lot of ingenuity on the part of companies to figure out how to cut through these supply issues. So, we've seen a series of supply issues go up and then get resolved. And that's what we're expecting to continue. I mean, coming back to wages, to this point, wages are really quite subdued. If we did see wage growth running well ahead of productivity, that would be a sign of concern. That would be a sign of increased risk of more broad-based inflation. So far, we're not seeing that.
Thank you, Governor. We're going to move now to Mark Rendell from the Globe and Mail, followed by Greg Quinn.
Lots of interesting stuff there. That's interesting to hear him talk about wages and how they sort of work into inflation, right? I think that's one of the best questions so far we got from that BNN Bloomberg reporter, saying like, hey, it's hard to find workers right now. Businesses can't find workers. We have to pay them more money, right? If we want more workers. That's at least his thesis. And he's saying, won't that lead to inflation? Because if we pay workers more money, they'll be able to spend more money. Consumer prices go up, so on and so forth. That doesn't sound like a transitory factor. That's essentially what he's saying. But Tiff here is saying that this is a temporary adjustment issue and that, businesses are just going to figure it out. He says there's a lot of ingenuity in the market and businesses will figure that out. I actually saw an article just recently saying that there was a business paying people or giving people a $20,000 grant to help with the down payment for housing to try to incentivize them to come work for them. I think that businesses are going to have to be creative if they want to get right back rolling. So, and Tiff Macklem here is saying that it's actually harder to reopen an economy than it is to just shut it down. Interesting takes there.
Quinn from Market News.
Hi there, can you hear me?
Yes, Mark.
Great. Thank you so much for taking the question. Wondering about the medium-term inflation outlook. It looks like, and as you addressed with your earlier question, that there are transitory things pushing inflation up now and over the next year or so. But it looks like in the projection, inflation dips down and then it raises back up, and it doesn't actually really settle until 2024. So once we're past the kind of transitory things that you mentioned in the earlier question, what is it that's keeping inflation elevated and leading to that secondary spike and that kind of trajectory towards back to target not happening until 2024?
Well, if you look at chart 18 in the Monetary Policy Report, Mark, it breaks it down for you in more detail. But let me put it in words for you. So, building off the answers I've just given, we've got considerable amount of excess supply in the economy. As these temporary factors wane, the considerable amount of excess supply in the economy that dominates. Inflation comes down in our forecast. So when you get to the second half of next year, inflation's around 2%. And then as you indicated, it then drifts up a bit in 2023. And that's really a consequence of our forward guidance. Forward guidance is an important part of our extended toolkit. And we've committed to hold our policy rate at the effective lower bound until slack is absorbed so that we sustainably achieve our inflation targets. So, in the projection, there's quite a bit of uncertainty about exactly when this will eventually happen, but in our projection, the output gap closes in the second half of next year. And because we're holding the policy rate at the effective lower bound until it closes, and there are some lags in monetary policy, you can expect to see some modest excess demand in 2023. The economy is expected to go into modest excess demand, and so that produces a modest increase in inflation above the target before we go back towards target in 2024. That's part of the flexibility that we have in our flexible inflation targeting framework. We have a band of 1 to 3, and given the truly exceptional circumstances of this pandemic and the huge size of this shock, we are using our extended tools, forward guidance and quantitative easing, and that's really what you see reflected. I would just conclude by saying I think forward guidance has been a very effective tool in our extended toolkit, and it's working.
On the question of forward guidance, you reiterated what you said in April about not raising rates until the second half of 2022 at the earliest. And I'm wondering, with GDP growth now coming in lower for 2021, with expectations that potential output is going to be growing faster, how do we still keep the forward guidance, that same kind of second half of 2022 target the same, given the other factors that are changing?
Well, for 3 points here, Mark. First of all, our outlook is not really that different from the one we put out in April. Of course, we've received a lot of new information. There are some differences, but if you step back, the outlook is not that different from April, and the output gap in April closed in the second half, and it continues to close in the second half. If you look at sort of the next level of detail, as you just indicated, near term, really the first half of this year, which is already over, GDP growth has been a little bit weaker than we saw in April. Q1 came in slightly below what we were projecting, and Q2 we have revised down our expectations for Q2 slightly, and that really reflects that the containment restrictions related to the third wave in some parts of the country were a little bit longer than we expected, and the supply constraints that I've mentioned. So, they're affecting, for example, production of cars. They can't get enough semiconductors, so they're producing less cars. Q2 has been a little bit weaker. So we're starting off slightly weaker, but the growth trajectory going forward is a bit stronger. And that really reflects the fact that we've seen rapid progress in vaccinations. We are more confident about the outlook. And even more importantly, Canadians and Canadian businesses are more confident, and that we think will be reflected in their spending and investment decisions. So we get a slightly stronger rebound. And if you look actually at chart 2A, I think it is in the monetary policy report, you can see this pretty clearly. So we start a little weaker, we have stronger growth. So by the end of the projection, actually, the level of GDP is actually slightly above. But you start weaker, you get stronger growth, it kind of evens out. And so that's why we're still second half of, output gap closes second half of 2022. I would underline, though, that there is a lot of uncertainty about exactly when the output gap ultimately will close. It's going to depend on the evolution of demand in the economy, but also the evolution of supply, which is particularly hard to assess given the unevenness and the very unique circumstances of this pandemic.
We'll turn now to Greg Quinn from Market News, followed by Paul Vieira of the Wall Street Journal. Greg.
Good morning. I would like to ask first about a bit about your views in general on what happens to the asset purchases from here as they're winding down. And for example, do you think it's necessary to completely end quantitative easing before you would raise interest rates?
Well, you're getting into future monetary policy decisions, so I'm looking forward to these questions at future press conferences. But I will provide some response. Well, first of all, you'll let me underline that our QE program is continuing. We will continue to be buying at a pace of $2 billion a week, down from $3 billion. We don't, because of the progress we've seen in the recovery, because of our increased confidence in the outlook, we don't need as much QE, but we continue to need quantitative stimulus, and QE is continuing to reinforce our forward guidance. As I said in the opening statement, looking forward, as the economy, or if the economy continues to evolve in line or stronger than our outlook, we won't need as much QE going forward. And so if that plays out, there will be future adjustments. And as we adjust QE down further, at some point we'll eventually reach a point where our gross purchases, will be roughly equal to the maturities. So in other words, the new bonds we're buying will be roughly equal to the bonds that are rolling off our balance sheet as they mature. When that happens, we'll be entering what we call the reinvestment phase. And in the reinvestment phase, I think you can expect we're still going to have a very big balance sheet. That's still going to be providing a lot of stimulus, but we won't be adding incremental QE stimulus. When we get to the reinvestment phase, how long we're in the reinvestment phase, those are monetary policy decisions, and that will depend on our the incoming data and our assessment of the outlook and our assessment of how much stimulus we need to achieve our inflation target. The only other thing I can say is, when we do eventually get to this reinvestment phase, there are also some sort of operational balance sheet management issues, and So we will need to look at those, and we will certainly be very clear on those implementation issues when we get there. But we're not there yet. Right now, we continue to need our quantitative stimulus program, and it's working.
Interesting stuff. Lots of insight there on what they're going to do with their quantitative easing program. Sort of a different future than I kind of expected. He said that they're going to continue their quantitative easing program. For those of you who maybe aren't as familiar with the QE program, that's how the Bank of Canada essentially prints. They're not actually printing paper money, but they're adding more money to the Canadian system to the tune of right now a lowered amount of $2 billion per week, buying Government of Canada bonds, essentially lowering interest rates across the broader economy. Because the bond price goes up and the yield goes down. That's another topic for another video. But they actually say that they're going to be tapering this quantitative easing program, which again could see interest rates go up a little bit, because as the demand for bonds goes down, the interest rate typically goes up. But he actually talks about a future where they actually continue their quantitative easing program at a lower rate, at the rate in which their current balance sheet has bonds that are expiring. So this could lead to a future where the Bank of Canada holds just massive amounts, probably around $400 billion worth of government debt forever, and just continues to refill that pool of debt that they're holding as the bonds reach their maturity, and the debt is owed by the government back to the Bank of Canada. So that's an interesting future. We can talk about that more after this press conference.
Thank you. Secondly, I wondered about the coordination of economic policy when the economy was hit with the pandemic. The government and the Bank of Canada did some coordination on putting in stimulus. With the confidence in the rebound we're seeing, do you expect to be talking to the government on the other side and taking some action to coordinate any removal of stimulus in the future?
Well, look, by legislation, I was going to say meet. We actually don't meet very often, but I do discuss economic developments with the Minister of Finance. We have the operational independence. We have a clear mandate, and we take decisions to pursue that mandate. Look, we're all working for the benefit of Canadians. We all want to see a good recovery. Certainly our job is to make sure that that good recovery comes with inflation that remains at 2%. And we're committed to achieve that, and we'll take whatever actions are needed to achieve that objective.
Okay, I've got 4 people left on my list and about roughly 10 minutes, so let's see how we do. Paul Vieira from the Wall Street Journal, followed by Shelley Hagan of Bloomberg. Paul, please go ahead.
Governor, you talked about looking at labor market indicators to judge the amount of slack. In the NPR, there's a lot of emphasis on the employment rate. Is that the key metric the Bank of Canada is going to be to judge whether slack in the labor market has dissipated or has been absorbed?
Yeah.
Can you expand?
Yes, I can expand. I guess my message here is I would discourage you from fixating on any one statistic. We really need to look at the overall health of the labor market. And just to give you, don't take this as a comprehensive list, but just to give you some, an indication of the kinds of things we will be looking at, obviously you're going to look at the unemployment rate. The employment rate has the advantage that, the unemployment rate, if people become discouraged about looking for work and drop out of the labor force, they're not counted as unemployed, because to be unemployed, you have to be actively searching for work. The employment rate actually looks at, how many people really are at work. So, that's why you want to look at both the unemployment and the employment rate. There are some other things, though. You'd want to look at, full-time employment. What is the composition of employment? For full-time, part-time, self-employed, private sector, public sector. You want to look at different parts of the labor market. As we've talked about repeatedly, the effects have been very uneven. I mean, men employment is about 1.5% below pre-pandemic levels. Women still a little over 2%. Those gaps have narrowed as the economy is reopening. We expect them to continue to narrow. The labor utilization rate, that's a broader measure, includes people who would like a job but aren't actively working. It also factors in how many hours people are working. So right now, labor utilization is about labor underutilization is about 16%. Pre-pandemic, it was 11%. In the worst days of the pandemic, it was over a third of the labor market. So we've come a long way back. Another one, you want to look at hours. It's not just employment, but how many hours. So, hours worked, total hours worked still about 4% below pre-pandemic levels. So, and that's not a comprehensive list. My message really is you really got to look at a broad range of labor market indicators and come to an overall assessment of the health of the labor market. And you've also got to look at productivity. You've got to look at investment. Those also contribute to how much capacity the economy has.
I'll skip my follow-up. Thanks.
Thank you, Paul. We'll turn now to Shelley Hagan from Bloomberg, followed by Jordan Press of the Canadian Press. Shelley, please go ahead.
Hi, Governor Macklem. Now that you're approaching the wrap-up of QE by adjusting the pace of purchases to $2 billion a week, can you give us an idea of how tapering looks like going forward? Would you ever kind of use the wording to target net purchases rather than gross purchases?
Well, I think I answered that question before. As I said, right now we need the QE we have. I've indicated that if the Canadian economy evolves broadly in line, or stronger than our projection, we're not going to need as much QE over time. And as indicated in the press release and in my statement, the Governing Council will be looking, in coming to that judgment, will be assessing the strength and the durability of the recovery. So those will be the key factors that will be weighing on future adjustments. And in the previous answer, I sort of gave an indication of, eventually that would get you to this reinvestment phase.
would you ever, I guess, be guided though on like kind of changing the language in your statement to like net purchases? When
Well,
you talk about how you're adjusting like the pace of purchases from your gross purchases to $2 billion, would you ever kind of?
well,
instead,
we talk about gross and net. There, gross is, so our gross purchases now are $2 billion a week. There are some maturities, so net is less than $2 billion a week. Right now, our maturities are relatively small. Going forward, as you roll forward, because we bought a lot over the last year and a half or year and 16 months, maturities will start to rise, and you can, that's all on our website. I mean, we disclose all our purchases. You can see when the maturities, so you can see how much will be rolling off.
Okay, we'll turn now to Jordan Press from Canadian Press. We'll wrap up after that with Tony Mace of Mace News. Jordan, please go ahead.
Good morning, Governor. My question is about the labor market as well. Can you just explain a little bit about how much scarring you expect in the labor market now that you've had a little more data to look at, and maybe just why the scarring may be either deeper or not as deep as you previously expected?
We are worried about scarring. If you look at measures of longer-term unemployment, they are very high. And what we've seen in previous deep recessions is that when people are unemployed for long periods of time, a few things happen. One is some people become discouraged. They stop looking for work. They drop out of the labor force. That reduces the overall capacity of our economy to grow. It's also pretty tough on those individuals. The other thing that when people are out of the labor force for a long time, they're losing opportunities for on-the-job training. They're losing learning opportunities, particularly for younger workers. That's really important. And so it can take, even when they do get a job, it can take them some time to get back up to, the income that they would have been making. So we do worry about scarring. As you suggested, I think the good news is that we are becoming more confident about a strong rebound. And if you look at the June employment numbers, you did see strong gains in youth employment, particularly for young women who have been hit the hardest. There's still it's still uneven. There's still catch up to be had here. But some of those hardest hit groups are benefiting quite a bit from this reopening, and we expect that to continue. That should bring down this longer-term employment rate, and so hopefully the consequences of scarring are minimized. I think the other element is that for some of these sectors that are coming back, the amount of training isn't as big as some other sectors. So again, the potential to catch up may be there. But this is something we're concerned about. We do think the scarring will be less than what we thought it might be 6 months ago, because we are more confident in that recovery. But it is a concern.
And I guess just as a very quick follow-up, given you're talking about a consumer-led recovery, I'm wondering, what is it that you've been doing maybe to add to that recovery? Maybe telling others, some of your friends and family, what they should be doing as well.
Well, I think I'm not sure I'm going to give too much personal advice. So what have I been doing? Well, I mentioned the example of well, if your gym's closed, maybe you buy a treadmill or an exercise bike. Well, I bought an exercise bike, and I will admit it's helped me get through this crisis.
Our final questioner will be Tony Mace of Mace News. Please go ahead.
Okay.
Hi, Governor. Thanks for the opportunity. You mentioned, I believe, some concern about the Canadian dollar, and if it were to appreciate further, that it could affect Canadian exports. How would you characterize what you've been seeing in terms of the exchange rate? And what kind of a move would attract your attention or concern?
Yes, well, exchange rate's always a tricky topic. So, as I indicated in our projection, we've assumed an 80-cent dollar. And let me just begin by reminding you, we don't target the dollar. That's an assumption. We target inflation. We have a flexible exchange rate. That's an important part of our framework. And that's an important adjustment mechanism. So we've assumed an 80-cent dollar. That is embedded in our projection. If the Canadian dollar were to be materially higher than that, I think we'd be asking ourselves, why is it materially higher? So if it's materially higher because of some good developments in Canada, that's the flexible exchange rate doing its work. So for example, if commodity prices were stronger, that's good for Canada. We are a big exporter of commodities. That means more income coming into the country. When the exchange rate appreciates, actually that spreads the benefit across the country because not just the commodity producers benefit from, but every Canadian who's buying imports benefits from it. On the other hand, if the Canadian dollar were to move for reasons higher, for reasons that are not related to some good developments in Canada. So for example, one thing we've seen over the last year, if we saw broad-based depreciation of the US dollar for US reasons that puts upward pressure on the Canadian dollar, that would be more of a source of concern in the sense that that would be negative for our exports. It would create more import competition for Canada, and that would dampen our outlook, and that's something we'd need to take into account. Let me stop there, and thank you very much.
Okay.
Tony, if you do have a quick follow-up.
Oh, okay. Yes, please.
Quick.
In connection with the labor market indicators and the array of indicators you mentioned, will you be targeting things like the jobless rate for low-wage workers or others who may have been hit most by the pandemic?
No. We have one target, and that's inflation. We are looking at those things because in order to get inflation sustainably back to 2%, you need to close the output gap. You need to absorb that excess slack. If we have excess slack in the economy, that means we're missing jobs, we're missing income, we're missing spending, and that will put downward pressure on inflation, and we won't sustainably achieve our inflation target. So that's an important input to achieving our inflation target, but the target is inflation.
And that concludes today's press conference. Thanks to Governor Macklem. Thanks to everybody for joining us and for your questions. I'd like to wish everybody a nice, safe, and healthy and relaxing summer. And we'll see you all in the fall. Take care.
Okay, interesting stuff there. Okay, so a lot from Tiff Macklem there. I think one of the most interesting things, though, that at least I found interesting in that was the way he talked about the future of the QE program. I think I talked about this a little bit midstream, right? Talking about like. He sort of hints at them potentially targeting a continued quantitative easing program, their bond buying program, where they continuously kind of print money into the system. A continuous one that focuses on keeping their balance sheet or all the assets they hold, all the bonds they hold at a net even rate, potentially in the future. Like, they've bought over $300 billion worth of Bank of Canada bonds, and that's going to increase over the number of months until they fully taper this program to zero. But then what happens is all of these short-term bonds, maybe these 5-year bonds, as those roll into maturity and those sort of expire, they're saying they're going to take that money and then re-buy Government of Canada debt. Now, this doesn't directly add money to the system, I wouldn't imagine, because they're likely not purchasing these bonds with settlement balances anymore. They'd be purchasing it just with the cash, for lack of a better word, that they're receiving when these bonds reach maturity. But that essentially means that all of the debt that the Government of Canada currently has with that the Bank of Canada holds, well, it's going to be perpetually funded by the Bank of Canada because they're essentially guaranteeing that they're going to be buying more Government of Canada debt. It's an interesting thing to watch, and it might be why potentially the Liberal government feels a little bit more comfortable spending more and more going into the future. Yeah, Alex, I know that you watch this stuff pretty closely too, saying Tiff provided more insight than I've ever heard in the past. Kind of shocking. Yeah, that especially on that topic, right? Interesting stuff. Yeah, because he hadn't really talked about what the future of QE looks like. We've seen since the financial crisis in 2008 that the states, they've just continued with that program perpetually. But it's interesting to see like how this sort of new form of monetary policy worldwide, how is it going to actually take hold? What's it going to look like? How do all these other factors affect that? It's interesting stuff to cover. I think we're going to wrap up the stream in a little bit, but I like to do this at the end of the streams. If anyone has any questions about anything, what we saw here today about real estate, if you don't already know, I'm a realtor in the Greater Toronto area. Also, I've been diving really deep into cryptocurrency, but just investing in general. If you have any questions about that, my thoughts on things, we'll do that for probably about 5 or 10 minutes here before we wrap up the stream, but some interesting stuff. One thing that, and if you do have a question, put @Russell Matthews in the chat because then it shows up in orange and I can see it more clearly. One interesting thing that he talked about was the question that was asked of Tiff Macklem saying, will you coordinate with the government to monitor stimulus programs? And Tiff said, yes, we do talk to the finance minister, Chrystia Freeland, the finance minister for the Liberal government. But he emphasized that the Bank of Canada is independent and they make their own decisions based on their mandate. Now, some more right-leaning conservative politicians, certainly Pierre Poilievre, along with other sort of more hawkish financial critics, say that, hey, it kind of looks like the Bank of Canada and the Liberal government, there's some sort of congruities that make them seem like they're kind of in cahoots, but that'll be something interesting to watch. But Tiff, of course, he says, we're separately mandated. Yeah. Alex says, I didn't catch the first 15. Did he mention anything about paring back MBS purchasing? I'm not sure. There's so many acronyms. What are you referring to when you say MBS? This might be just something that I'm ignorant about, but I'll let you know. He didn't say anything specifically about MBS, but maybe I can talk on that more when you clarify there, Alex. Donnie Darko says, what does the inflation projection mean for low-income families from now to 2024? Great question. So they're saying that inflation projections, they're expecting it, I'll scroll back up to my notes here so I can get the numbers that he was saying, but essentially they're saying that we're expecting to see 3%, above 3% inflation until like mid-2022, at which point we'll get back within their comfortable band of 1 to 3%, but he doesn't actually think we're going to see inflation back to target at 2% until 2024. So 3 years, right? That's a long time for our currency to be, or the cost of living to be going up 3% each year, and our currency being devalued equally by that amount because the dollars that we have to spend don't go as far, right? So that it does have a big impact on low-income families more than anyone else. It's sort of, and this is a talking point that the Conservatives use a lot, it sort of is a tax on people with low income, right? Because when we see increased inflation, largely the people that suffer from this are the people who are just making ends meet, aren't able to save, for one, but saving doesn't do you much good in an inflationary environment. It's mostly the people who are able to invest in things like stocks and real estate and I believe personally cryptocurrency and certain cryptocurrency. We can talk about that more later if people have questions about that. People who can invest in assets typically do well in inflation, as well as people who can take on debt for things like a mortgage. If you can afford a mortgage, inflation actually isn't the worst thing in the world because the debt that you owe, well, that's worth less, right? Because it's worth less in comparison to other things, and potentially in comparison to wages in the future. So inflation is a good thing if you have a lot of debt. Might be why the government of Canada wouldn't hate that, because the debt that they owe would be worth substantially less. It's a little bit of a meandering answer for you, Donnie, but it does have a big impact on low-income families. Yeah. Freedom of Culture says, housing future for Ontario/Canada based on what you've heard here today. Well, it seems like they're not planning on actively trying to raise interest rates until at least the second half of 2022. This is sort of the guidance they've been giving. But he did say that the Bank of Canada's forecast inside of this MPR, this monetary policy report, is that real estate, they expect to be sort of moderating itself, slowing down slowly over the next little while. Like we've sort of seen here, some people say this is just a summer lull, but other people think, hey, this is actually like the trend that we're seeing, that the heat that's been in the real estate market, well, it's going to decrease over time. But I think the number one thing that's going to have an impact on real estate markets is, of course, interest rates, right? If it's less expensive to get a mortgage, people can afford more home. That leads to raising real estate prices. And it doesn't seem like there's too much strong government policy that's coming into place that can really affect real estate prices. So I think that we're going to sort of see sort of an evening out in terms of the extreme growth we've seen in real estate. But I don't really project a decrease in prices in many markets. But of course, real estate is a very hyper-local industry. So based on different local economies and the jobs in those economies, we can see different things happening in different markets, of course. Back to CPI. Why do they insist on using 1 to 3% when really it should be 0 to 3%? Well, they use 1 to 3% because that gives them a 1% range on either side of their target, which is 2%. Central bankers largely around the world believe that 2% is the healthy rate of inflation, saying that a certain amount of inflation is healthy for the economy because it incentivizes people to spend. If we see deflation, people don't want to spend because their currency is gaining value. So a little bit of an inflationary pressure produces a currency that people are likely to spend, and that can be good for like the GDP and the growth of the Canadian economy. So they want 2%. That's the number they're targeting. So they don't say 0 to 3% because in their eyes, 0% inflation is just as bad as 4% inflation, right? But for different reasons. Freedom of Culture says, is it smart to buy, sell, hold housing? I think I sort of covered that a little bit answering your previous one. Good question there. Yeah, I'm sort of scanning through here to see questions. Again, if you want to make it easy for me to see, you can sort of tag me like people have been doing. Kifo says, don't get mortgages now, buy small, but buy free of debt over 5 years. Yeah, I mean, some people really don't like using debt. I think that debt in certain situations can be really powerful for building wealth, especially when we have super low interest rates right now. As long as you project, like, what will I have to be paying in the future? Am I going to be able to make those payments? Do you know what I mean? This is why for some people, especially people who aren't like following interest rates as closely, variable rate mortgages, even in instances where we see mortgage rates going up, they can actually be helpful because it's sort of it's like putting a thermometer like on your payment, so you're always knowing what the current market's going to be. So your payment would sort of increase over time. So it's not just like a big shock and a big surprise that, oh my gosh, I'm paying $700 more per month at the end of your 5-year mortgage term when you have to renew, right? It sort of allows people to get used to it, like sort of turning up the heat over time. But of course, it is a little bit more expensive if rates go up. Dust Taker says, don't sell your house unless you have somewhere else to go first. Yeah, that's been an issue for some of the clients that I've worked with, is that, it's difficult unless you're downsizing, right? Unless you're retiring and downsizing. It's difficult to find a place that you can afford. Like, it's harder and harder for people to sort of go along the path of real estate ownership, like where someone might start with a condo and then work into a townhouse and sort of like buy and sell these things as they appreciate in value, because it is still super competitive for buyers out there. Bank of Canada has cherry-picked data skewing to predetermined biased outcome. Perhaps I need to look more into the NPR. Look at the Bank of Canada assets, now almost all government bonds. Yeah, that's. I was looking at that chart and I looked at it a little bit in my video yesterday that I put out, but just like the huge amount of Government of Canada bonds that the Bank of Canada holds. Previous to the pandemic, there actually wasn't any QE program. Like there wasn't any Bank of Canada bond buying, the mass bond buying program. So that's definitely interesting to see. Freedom of Culture says, Russell, do you see Bank of Canada doing a sneak interest rate hike? I know they say Q3/4 2022, but how likely could that happen over the winter? I think that they would likely give us some warnings if they were going to increase interest rates quickly. I think that the raising of interest rates is kind of like a big risk on the Canadian financial system as well as the Canadian government, right? Because of how much debt they have. If they were to issue any more debt, if they had to pay higher interest rates, the cost for them to service that debt would certainly go up. So I think if we see interest rates, we're going to have the warning signs ahead of time. They're going to talk about it ahead of time. And at the very least, I think the only reason we would really see a fast uptick in interest rates is if we have crazy, unexpected inflation numbers. If you haven't already, subscribe to the channel, hit the notification bell, because I believe on the 28th of this month is when we get the new inflation data. But if we saw, for some reason, like a huge month over month of like 1 to 2% inflation raise, like getting to a rate similar to the States is at like 5.6% inflation right now, or for their CPI year over year increase. I think if we started to see something like that, then maybe the Bank of Canada would get a little bit more worried and they might gradually increase interest rates again. But he's saying here that we still have slack in the economy, slack in the labor force, and that itself is a deflationary pressure, because when not a lot of people are working, well, we have less production, less spending, less money being made, less ability for those consumer prices to go up. So he sort of thinks that this is going to like weigh things out for the next little while. Sage says, but then shouldn't they just be honest and use a 0 to 4% range instead and call the two the happy middle? Well, I mean, yeah, maybe, like, because they're saying now that they're actually kind of comfortable with like the mid threes that we're at right now. But I think the only reason they're comfortable with it is because they don't believe that it's actually going to be sustained. It's going to be transitory based on like these things that he was talking about, gas prices going up, the semiconductor shortage, along with other bottlenecks in the supply chain. So yeah, I think that they go with the 1 to 3% because they're not upset with it long term if it's in that range. But I think certainly it would be concerning to stick consistently at 4% or consistently at 0%. Brian says, do you know how the economy of other countries are doing around the world and how they compare with Canada? Are we better or worse? We're similar to a lot of them. I haven't dug in too deeply. Certainly it's sort of, it's hard to compare like month to month how we're doing versus other economies because people are at different stages of reopening, right? So it's tough to really compare right now because of how rapidly things are changing. But I guess I don't know entirely how well we're doing comparatively. Certainly the States has opened up a lot more and we're seeing more inflation there than in Canada, but we're also earlier in our reopening timeline than the States. They started before us. Alex says, we're in an inflationary monetary system. Unfortunately, debt is a good thing in this structure. It's the only way to build wealth. You just need to maintain your balance sheet. Yeah, you're right, Alex. As long as you can service that debt and use that debt to grow wealth, then it's a powerful tool, right? Like debt is like this like sort of double-edged sword for people who know how to use it and know how to use it for their financial gain. Well, then it's actually like a really positive thing because it gives you the ability to control more assets, potentially for a low interest rate, as long as you can service that debt over time, right? And you have certain protections in place for yourself. But on the other hand of things, for the lowest income Canadians who don't understand how debt works, it can often be the sort of path towards financial ruin, right? So it's a double-edged sword, but it's certainly the way the system currently is set up, Alex. Oh, thanks. I'm gonna butcher your name, but you say new subscriber. We'll use your Newton promo link. Just wanted to say thank you. Yeah, thanks for tuning in. I'm glad that you've joined the channel. Yeah, that Newton's one of my favorites to buy cryptocurrency through. They've just opened up the ability to to buy a whole range of different different tokens. A lot of ERC20 Ethereum tokens. I've over the past month gotten pretty hyper bullish on Ethereum. Again, of course, not financial advice. I'm not saying go buy this, but I think that there's a lot of development and a lot of growth and a lot of actual value being created there. So that's certainly what I've been buying most heavily over the past couple of months, trying to increase my ETH stacking. But yeah. So you can use Newton down there if you'd like to get in on that too, or buy anything you'd like. I think it's a great Canadian business. We are worse since we have the biggest housing bubble in the world. Yeah, that's a good point, Dom. We have seen I made a video on this a little while ago. I think it's titled the NDP just called out Justin Trudeau, but we go over a whole bunch of data in that video if you haven't already seen it. About Jagmeet Singh of the NDP put out this tweet saying here's all the reasons Canada's in the worst place ever in the world, and we go over and sort of fact check that. But there are a lot of ways and statistics, certainly in terms of the major developed countries, that Canada is increasingly a tougher place to live because of the cost of living increase. Certainly the cost of rent and the cost to own a home is increasing disproportionately from wage increases, right? So that's one of the things we cover, and we go over the NDP's plan, and they say they're going to build 500,000 houses that don't really go into too much detail on how that would happen. It's going to be interesting, and I think this channel is going to sort of transition into covering this more and more, but I think we're going to see an election in September, and it's going to be interesting to see hey, how are the different parties going to address these issues? I personally believe that the only way we can really solve these housing crisis issues is to open up the floodgates for more supply to be added, make it easier for developers and builders to build more units, sort of allow for a little bit more urban sprawl so we have more area to grow, and maybe make it easier for different cities to intensify and make it a little bit harder for people in those neighborhoods to say, hey, no, I don't want more people coming into my city, because I think that's how we get vibrant cities and lower costs of home ownership, is if we sort of intensify, build more multi-unit buildings, allow for more development. But that's just one guy's opinion as of right now, and I'm constantly learning and changing opinions on things, but that's just what I'm thinking right now. I'm not familiar with Basel IV, Sage. Sorry about that. Russell, do you have a video where you talk about why you're bullish on ETH? I actually haven't made a specific ETH one, and I did make a video about maybe 2 months ago, before I really started going down the rabbit hole of DeFi and all of the other applications and uses and functionalities that are actually built into the Ethereum network. So I haven't really made a full video on why I'm bullish. But if I'll summarize, I did make a video talking about how I'm holding Bitcoin, Cardano, and Ethereum. More so, I'm mostly holding Ethereum as of late, for so many reasons, because of the power of smart contracts and what that can do. We see the increase of DeFi, decentralized finance, as an industry, and I think that that's going to swallow the entire banking system. And I think that DeFi paired with, there's actually blockchain sort of gaming that's happening, that's allowing for a sort of shift in the labor force to actually be doing enjoyable things for work. We see people in the Philippines right now making a living, or a higher than minimum wage, by playing a game called Axie Infinity. This is something I've been sort of toying around with too, where you can sort of play games and you're rewarded with tokens that have value that you can then sell and use to make money. So it's sort of like an interesting shift there as well. And then the other third thing I'm bullish with on Ethereum is DAOs, or decentralized autonomous organizations. This is what I believe to be the company of tomorrow, where through code on the Ethereum network, as well as potentially other chains, we could see the middlemen, the middle management, the CEOs, all sort of automated out of the company, so that the value that's created by companies accrues to both the users as well as the people who are working to make that company or that DAO better, right? So I think that could have a huge impact in the future. This is like 10, 20, 30 years stuff I'm talking about, but that's what I'm really, really interested in. Oh, thanks, Donnie. That's so nice of you to say. Election for sure. Yeah, Alex. Going through here, finding a couple other questions. So many people are leaving the country to live in Mexico and other places. Yeah, if there's a cheaper cost of living, sometimes. Buying land and feeding yourself is better to me than crypto. You can't eat crypto. Yeah, I mean, everyone has different views on it and different levels of comfort and have done different levels of research. But yeah, certainly buying land and being able to be self-sustaining. I mean, what's the point of having money than to keep yourself alive and attain like a safety and a stability in your life so that you can live and enjoy your family, enjoy your health, enjoy the things that you want to enjoy in life. So if you can do that without investing in these other things and you want to be like self-sustainable on some farmland somewhere, then more power to you. I think we should be optimizing for human happiness rather than many other metrics. Yeah. Freedom of Culture says, I've heard they will blow up the green belt. Will that tank the housing market or at least stop the growth? So that's a very Ontario-specific thing you're asking there, Freedom of Culture. But there's something called the Green Belt, as well as the Oak Ridges Moraine around Toronto and like the GTA, that sort of puts a cap on the ability for developers to expand out into a lot more of Ontario, because there's like certain environmental provisions that allows them to, or forces them to not be able to build on these certain areas. I think it's very unlikely that they'd blow that up. I don't really know. I think it's more likely that expand east and provide more sort of transit abilities all along, like between Toronto and Ottawa, right? There's a lot of land in there that hasn't been developed, or even make it easier to intensify. Those are the things that could make it easier to get into the housing market. Don't think it's going to tank it, though, but it could, like you said, slow the growth a little bit. Sage, I'm really not super familiar with what those global bank capital requirements are due for implementation in January 2023. Okay, so in terms of like how much money they have to have on their balance sheet in order to lend out a certain amount of money, they're changing that. Okay, I need to look into that a little bit more. Thanks for bringing that to my attention, Sage. Alex says, I hear you about housing. Hurts my heart to see people on the street or in shelter. Yeah, it's one of the biggest problems, and I feel like it doesn't get enough attention, and we're sort of starting to get desensitized around it. I guess I don't really need these anymore. We're starting to get desensitized around it, right? Like, we're just like starting to like accept, hey, maybe the younger generations are just gonna have to rent forever unless they can like find a way to make more and more money. This is something that I think it still is possible to own a home, but you have to do the right things. This is something I talk a lot about in the course in the description below, but you need to optimize for the 3 levers of building wealth, right? You need to be able to spend less, earn more, and then invest the difference, right? And doing all those in the most effective way, and really focusing on spending less. And there's some creative ways to do that with like rental housing and things like this. But I think it still is possible to buy a home. But it's heartbreaking to see not only like the homeless and the issues we have with the most at-risk Canadians, which is a huge issue, but also like the shrinking of the middle class, if you can even say there is one anymore. I think that one of the biggest problems, and we see people like the NDP talking about this, but also the Conservatives talking about this, just with different language around the problem, but it's the growing wealth gap between the haves and the have-nots. And I think that this pandemic has really sped that up, especially because we've seen asset prices, housing, like real estate, stocks, even crypto, all different kinds of asset classes have gone up in value. So that hugely benefits people who are able to have enough money to invest, while at the same time, the most at-risk and poor who haven't actually done the research and learned how to invest and have prioritized that earlier in their life, well, it makes it harder and harder for them to get into those assets themselves, because they're overvalued, or not potentially overvalued, but they're valued higher than they were before. It's interesting stuff. Thoughts on the $29 billion hyper train being built in Alberta? Seems to me someone is planning something big out that way. Yeah, I saw that announcement. I saw that announcement by, I think, Kenny, the premier. in Alberta, but I don't really know too much about it. But yeah, maybe there could be more development happening out that way. Certainly, housing prices are a little bit more realistic in those markets, especially with like the certain aspects of the struggling industries that are in those sort of resource-rich provinces. Only the few largest global corporations will survive and own everything, thus everyone beware. Yeah, that could be something that happens. Lots of low-income earners having lots of kids because of child tax benefits. The wealth gap isn't going to be sustainable over the next 20 years. There will for sure be a basic income in the near future. Yeah, I mean, I'm interested in basic income. Now, when people talk about it, I think that they talk about the less pressing things that are forcing that to be an issue. Certainly we're seeing this wealth gap expand, but I think when we think like 10 years down the line, 20 years down the line, there are so many industries that are rapidly evolving right now. We've got like rapidly evolving AI. Soon there's going to be tech that can do most of the jobs that humans do better than humans. So I think that there is value in considering how are we going to restructure the way that resources are distributed across the broader society when no longer are humans needing to do the work that we're traditionally doing now, right? And that's part of the reason that I'm interested in crypto, and specifically like the sort of changing of like what is the future of work? What does work look like for humans in the future, especially with this rapidly changing technology? That's something that I'm interested in, is like maybe we restructure things so that maybe a UBI could work, or maybe the existing monetary structure we have right now isn't best suited to where the future is going, and I think that that's something that deserves a lot of thought, and I think people should be thinking about. But I don't hear people talking about it a lot because it's kind of abstract to talk about it and think about these sort of things, you know? James asks, Russell, do you know much about crypto and taxes with Aboriginal people and or companies across Canada? I don't know how that rolls into Aboriginal people and how that works. I know that you do pay capital gains tax, or the larger population does pay capital gains tax when they convert their crypto back into a fiat currency. So you got to keep track of that stuff. It's not a taxless land. If you've made some gains on cryptocurrency, you do have to pay the piper, especially if you convert back into fiat. But I think largely like you're not going to see a need to convert back into fiat. So it's going to be interesting to watch how the CRA's tax policy evolves around cryptocurrency in the next number of years, where I personally think it's going to get even bigger. Alex says, I think they somehow roll CRB into UBI, even though their studies in UBI have just been voted on in the House of Commons. Yeah, it could be a potential future. I mean, right now the CRB program's scheduled to end in September, right? And if we see the continued employment numbers going up, they might not have even extended it to the maximum that they can right now, which is to the end of November of 2021. Right now, that's when the program's set to change. So they'd have to pass a whole bunch of new legislation before then. I don't know if it'll roll in directly, because I just don't think they have the time to actually be able to, one, potentially have an election and then get back to work. And two, to actually be able to write, draft, debate, and pass the legislation to make something like that a reality in time for it to directly roll in. But I think that it certainly could be something we see in the future, especially given at the Liberal Convention this past year, they actually voted on a number of UBI policies that they want to roll into the Liberal agenda. The leadership of the Liberal government is a little bit less enthusiastic about it than the voting populace of the Liberal Party, but it definitely seems like there's growing traction for something like a UBI. An earned income tax, Zach Greenwald says, an earned income tax credit is the best approach to universal basic income. Okay, so you're saying instead of like putting out like say $2,000 checks every month, like we've seen with like the CRB and CERB and stuff like that, that it would be better structured as an income tax credit. That so that people who are making below a certain income wouldn't have to pay as much in taxes, or might even have like a refundable tax credit where they could get money back at tax time to sort of subsidize them. Yeah, there's lots of different structures for it. Yeah, there's definitely a potential future, and it's more in line with some of the other things we've seen that there's already structures built up currently. USA just announced they're researching federally implementation of basic income. Canada will at least follow suit with them. Yeah, maybe we definitely import a lot of our policies from the States. Canada can't afford basic income anymore. Well, I mean, if the Bank of Canada is just going to keep buying their debt, what can't they afford? The whole system is there's a lot of question marks there. Is there going to be a new disability benefit, asks Dark Cross. That's something that Carla Qualtrough, before they took their summer break now for 2 months, introduced, but there's not a whole lot of detail inside of that bill, so I think it's definitely going to be quite a while until something like that were to come in. Freedom of Culture says, Russell, I'm on the fence to sell my house, or should I wait? Can we see more crazy growth in housing? Niagara Falls. My place is up nearly 40% since last year. I thank you for your opinion. Of course, it's really hard to tell someone whether or not they should buy a house or sell a house unless you know their individual personal situation and what their plans are, what their goals are. This is something I say to the clients that I work with in the Greater Toronto area. If anyone is interested in buying or selling, you can reach out to my email down there. But this is something that I say, it doesn't always make sense to buy or sell unless you know what your individual goals are. I think we could see continued growth, albeit slower than over the past year. But it really depends on what are you planning on using that money for? If you were to sell it, are you going to put that into another investment, or are you going to put that into buying another house? Is this the house you live in? Is it a rental property? There's lots of factors here. One thing that you could consider if you sort of don't want to sell, but you want access to that capital, is you can do something called a cash out refinance. That's that allows you to remortgage your property and sort of take out a little bit of the equity that you've gained. And because interest rates are so low right now, there could be some potential arbitrage between you getting that money back, paying the interest rate on the mortgage, and being able to make more than your mortgage rate in some other investment, and then you sort of make the split on that. That's what a lot of people will do, making sure that their return on equity is actually working out for them. Matt says, if we can afford trillions in bailouts for Air Canada, then we can afford a UBI. I don't know if we've bailed them out in terms of trillions, but definitely a lot of problems that a lot of people think the UBI could be a potential solution for. But yeah, like Kimberly's saying, there could be some problems with UBI in terms of how they roll it out. Again, the devil is in the details, right? We can't really assess whether UBI would be good or bad until we know, hey, what are the guidelines? How does this work? How are we restructuring things? I think it's really hard to get a good idea until we actually see some concrete legislation around how it would work before we can form our opinions about it. Yeah. But with all that said, I think we're going to wrap it up here. It's past lunchtime for me. I'm feeling a little bit peckish. So I'm going to go eat something. Maybe, what do you guys think I should get? I might go out for something. I treat myself, But thanks for everyone for tuning in. If you haven't already done so, like this video. It'll help more people see it in the future, the replay of it, and as well subscribe and share this video with your friends if you enjoy the content. I really appreciate it. And if you haven't already, check out the links in the description. There's a couple different affiliate links in there that help me out if you're interested in starting to invest either in stocks or even in ETFs. There's a Wealthsimple link down there where you can get, I believe, $25 free when you sign up with it, as well as a Newton link for cryptocurrency where you can get $25 when you sign up for it for free when you deposit, I believe, $100. So check that out. There's also the course in the description if you want to learn more. Check that out. It's something I've been working to and continually add content to sort of help people sort of get the understandings of what's going on in Canada and how you can actually effectively build wealth here in Canada, something that should have been taught in schools. So check all that stuff out, and I appreciate everyone for coming in here. I have a lot of fun getting to know people, and if you've been in here chatting, I appreciate you. I start to recognize people after a little while. So I'll see you guys in the next one. And with all that said, I hope you guys have a good rest of your day, and I'll see you next.